Invite Trideep Bhattacharya from Edelweiss AMC. He manages so many funds, the mid and the large cap, the flexi cap fund, the mid cap fund, small cap fund. He joins us from Edelweiss AMC to talk about the market and the way forward. Trideep, morning, and thank you very much for joining in. Season's greetings to you, right? Almost, from tomorrow, the celebrations begin in the city of Mumbai and, even outskirts. But tell us, how are you feeling about the markets now? What is the call that you're taking? What are the changes that you made to your portfolio?
First of all, thanks for inviting me to your show. And ahead of the festive season and just the start of it, I wish everyone a good time. I would say that actually over the last month or two, we have taken some profits off the table. We have taken some profits off the table in some of the areas that we have been pretty bullish on for the last 2 to 3 years, which include capital goods, which include defense names, which also includes the PSUs. These three areas we have taken profits actually. Not to say that the sector leadership is likely to change or the fact that earnings momentum in these areas will not be good. But I think it is just that the valuations in terms of the way the stocks were factoring in future years of growth, that seemed a little full for us. The areas that we added to in terms of our portfolios have been basically IT and consumption as a theme. These two areas is something that we have increased our weight on. We are right now marginally overweight IT, and we would also be marginally overweight consumption, courtesy last 2 or 3 months of our action and a little bit of price action from the market.
So to what extent have you booked profits in capital goods, defense and PSUs? Are you completely out, or have you pared half of your exposure? Are you now underweight?
So I think overall we have halved our overweight stance in capital goods. We have more than, we actually, you can call it, we have taken the 70% of overweight out of defense, particularly in the light in the last 3 months. We would be overweight, but we would be overweight marginally at the moment in defense. I think all the points that I've talked earlier with regards to the order book being good and also the earnings momentum being strong is good. But in the last 2 or 3 months, courtesy, I think, thematic funds which have particularly been oriented towards some of these more popular themes, in my opinion, have sort of led valuations to be on the higher side, which is what we have taken a view on and added to those areas which have not moved over the last year or two, which is, as I said, IT and consumption.
Trideep, good morning. Thank you so much for joining in. Season's greetings to you as well. And you mentioned you've turned overweight on IT, but how much of a risk does this US economy concerns weigh on this overweight position? Because the IT stocks have rallied considerably in the last month and a half. But now with the jobs data coming in, and if at all the jobs data turns out to be worse than what the street is anticipating, and then you see some more fears coming across the US economy, what does that do to Indian IT companies itself? Because whether we like it or not, the majority of their business does come from the US market.
Yes, indeed. So overall, we actually turned overweight on IT about 4 months ago. Since then, we have had some, as I was saying, we have had some price action of the stocks in our favor. The moot point here really, though, is in the grand scheme of things, the expectations in IT or in consumptions are still relatively muted. I'm talking about Indian IT. The budgets have been soft anyway over the last year and a half. And having met some of the tech companies, while they are saying that we have not seen a meaningful uptick, they are saying that things are actually bouncing around the bottom with regards to allocations, and in actually pockets, some discretionary projects are starting to materialize. So that's the status from a demand scenario right now. Our expectation from IT really is that overall demand is unlikely to materially improve from here, but it will not go worse. With regards to US, the rate cuts and whatnot, my sense is that clearly initially rate cuts will happen when the data turns out to be bad, and these stocks, like in the United States, have taken or will take a knock. But once we are through that phase, this is one area which will ultimately benefit from the rate cut cycle. If you look at tech and correlation of tech versus the rate cut cycle in the United States, they have over time actually moved in tandem. So we think as we get to next calendar year, tech could be a good place to be. This year, it is most like bouncing around the bottom.
Okay, so things don't get worse from here on, but for a recovery in IT demand, we still have some time to go. But Trideep, do stay on. Trideep, you want to come in and comment on this? Do you think this is potentially a reason why we are seeing a downtrend in today's market? And how many stocks might get impacted? We're talking about an FPI holding 50% of his holding in a single stock, or 25,000 crore of an AUM. Is it a large universe of stocks which could potentially get impacted?
So I think overall P-note participation in the markets have gone down materially over the last few years. And the regulator had sounded off in these terms for quite some time, actually, over a period of time. So my sense is that the FIIs or FPIs would have wound down the major positions if they had any over a period of time. While this would be one of the reasons that I'm sure is probably causing a sentiment issue amongst FPI, but I don't think this is a major issue. I think overall we've had a good rally heading into a potential rate cut mid of September. And as we get closer to that, and we're sitting on good profits, we are seeing some profit booking at this point in time. I haven't heard any fundamental concern with regards to demand falling off the cliff, or some such issue which is prompting a sell-off. In fact, on the contrary, I would say that recent channel check seems to be suggesting that on the consumer durable side, actually demand has held up quite well in the pre-festive season era. And I think in that context, actually, as time progresses, you might see some better behavior with regards to data as we get into the festive season or the start of it.
Right. Trideep, speaking of the festive season, a couple of sectors that come into mind immediately are the consumption-oriented sectors, be it auto, be it FMCG. What's your call there? Because there has been commentary coming in from a lot of these FMCG players that rural demand is picking up. The similar sentiment was echoed by a lot of the auto companies as well. You saw those in the two-wheeler sales. What's the call there? How is the valuation picture looking like right now? Because while autos may have given decent returns in 2024, you can't say the same for the FMCG stocks.
True. So I would say at this point in time, we have turned marginally underweight autos. That is predominantly because we have made good amount of returns, and particularly the stock selection in two-wheelers, etc., have done quite well for us. We continue to remain in the context of the sector overweight on two-wheelers and on companies which have higher rural salience. But general PVs is something that we are relatively cautious on. Also, there is a big IPO slated to happen, which will probably consume some of the capital from which is present in some of the other names. So there could be a bit of reallocation coming in that segment. I think overall, in the context of consumption, consumer discretionary, and within consumer discretionary, the areas which are positively impacted by rural recovery could be in consumer durables is the way to go. I think that's one area where we think that on the back of reasonably strong monsoons, particularly as the sowing data comes around and the benefits of that flows through the cash flows of farmers, the spending patterns on that side, on the consumer discretionary exposed to rural side of the economy would actually tend to do well. In the consumption side, that's the spot that we have picked within the whole segment to add our positions. With regards to FMCG, yes, we have increased our weightages in the segment, but again, with relative focus on those companies which have higher salience on the rural side. So in many ways, we are believers of the rural recovery, driven by a slower base and also monsoons. And third, if I may add, a little bit of populism that we might see or are seeing ahead of three local elections in major markets.
Thank you, Trideep. Good talking with you this Friday morning. Enjoy your weekend. May Ganesha, Lord Ganesha, bless us all with good health, happiness and wealth. Slip into a break.